Welcome back to Global Power Play, your go-to source for the latest global political news. This is our weekly recap, where we bring you all the biggest stories from the past week, covering key events from the US, Europe, and around the world. Sit back, relax, and let's dive into this week's most important updates. The European Union has just escalated its response to US tariffs, joining China and Canada in implementing countermeasures. This trade war, once focused on steel and tech, has expanded to food, impacting farmers worldwide. As President Joe Biden shifts U.S. trade policy, the fallout for American agriculture is becoming devastating. U.S. agriculture in crisis. President Biden's recent move to impose additional tariffs on imports has sent shockwaves through the agricultural sector. These tariffs, which can go up to 25%, have effectively shut out U.S. farmers from key markets, most notably China. In 2024, China's soybean imports from the U.S. plummeted by over 30%, leaving Brazilian farmers to dominate the market. The results are immediate. Fields once abundant with soybeans now sit idle, and American farmers are finding it nearly impossible to compete. Corn silos overflow with unsold grain, and livestock auctions are flooded with desperate sellers cutting prices to survive. Bankruptcy filings are rising at the fastest rate since the 1980s farm crisis, with many farmers now facing financial ruin. Global shift in trade. This U.S. agricultural collapse is reverberating globally. Brazil, Argentina, and Paraguay are seizing the opportunity to expand their market share. Brazil's soybean exports to China reached record levels in 2024 as the country expands its agricultural footprint. Meanwhile, Argentina and Paraguay are aggressively pushing into Asian markets, previously dominated by American exports. Countries like Australia and New Zealand are also ramping up dairy exports to fill the gap in Asia left by American producers. The shift in global agricultural dynamics is swift, with new players capitalizing on the opportunities opened by U.S. retreat. The Indian battle, GM crops versus local farming. Meanwhile, a new front has emerged in India. U.S. negotiators are pushing India to open its agricultural markets to genetically modified GM American crops like corn and soybeans. This has led to massive protests from Indian farmers, especially in Punjab and Uttar Pradesh. Environmental groups also warn that introducing GM crops could undermine local farming practices and biodiversity. India, with its rich agricultural heritage, is now at a crossroads. Accept the influx of cheaper American grain or protect its local ecosystems and food sovereignty. The global economic disruption. The economic fallout from these tariff wars is not just affecting farmers. It's beginning to shake the global food system. The International Monetary Fund, IMF, recently warned that escalating tariffs could lead to mass job losses in agriculture, not only in the U.S., but also in developing nations dependent on exports. In the U.S., farmers are facing a double whammy. Markets for their goods have shrunk, and the government's bailout measures are no longer enough. Bankruptcy rates are soaring, and suicide rates among farmers are climbing as desperation sets in. One farmer said it best: "You can't farm if the world won't buy your crops." The impacts on global food prices. As global trade routes shift, food prices are rising. Dairy, grains, fruits, and vegetables are all seeing price hikes due to disrupted supply chains. The real pain, though, is being felt in food banks, which are bracing for an increase in demand as low-income families struggle to afford basic nutrition. For years, some of the most recognizable German car brands, Volkswagen, BMW, and Mercedes-Benz, have been synonymous with both luxury and American-made vehicles, owing to substantial investments in the U.S. market. These companies built large manufacturing plants and established deep ties with American consumers. However, recent geopolitical developments have shifted the automotive industry's focus. In a surprising turn, German car manufacturers are increasingly choosing China as their primary destination for investment. This represents a significant shift for the U.S. market, which had long been considered a key player in the global automotive industry. Why are the giants of German engineering, brands that once saw the U.S. as a profitable and reliable base? Before we dive into the details, don't forget to subscribe to our channel, activate notifications, and stay updated with all the latest developments in the automotive world. Now let's break down what's happening in this ongoing trade war. The shift towards China. Under the leadership of Donald Trump, U.S. trade policies underwent a radical shift. America First became the cornerstone of his administration's approach to global trade, leading to tariffs imposed on Chinese and European imports, including automobiles. The Trump administration argued that foreign manufacturers were taking advantage of the U.S. market, leading to an imbalance that harmed American workers. For German automakers, this created a problem. The rising tariffs on European-made cars made the U.S. market less appealing. Companies like Volkswagen, Audi, and Mercedes-Benz were finding that their profitability in the U.S. was being squeezed by protectionist policies. China, the new automotive hub. Germany's shift toward China is not just about avoiding U.S. tariffs. The Chinese market offers significant advantages that the U.S. cannot compete with. China is the world's largest automotive market, with sales projected to grow as its middle class expands and purchasing power rises. The Chinese government has also rolled out impressive incentives for electric vehicles, EVs, and smart mobility solutions, areas where German manufacturers are eager to make headway. China's focus on electric vehicles has especially attracted German car brands. The Chinese government provides extensive support for EV production, including subsidies, tax breaks, and a growing infrastructure for charging stations. Furthermore, China is advancing in crucial automotive technologies such as autonomous driving and electric batteries. Long-term strategic decisions. As we look at the global market, we see that U.S. tariffs and trade uncertainties have made the U.S. less attractive to foreign investment in the automotive sector. In contrast, China is offering a stable, predictable, and profitable environment for automotive investment. Germany's largest automakers have already made significant inroads into China. Volkswagen, for instance, continues to maintain a dominant position in the country with its joint venture partnerships, including a major collaboration with SAIC Motor, China's largest automaker. In fact, Volkswagen has seen its sales in China outpace its numbers in the U.S., with 2024 figures showing that over 40% of its global vehicle sales came from China. Mercedes-Benz has also embraced the Chinese market, having opened several new production facilities in the country to produce both luxury vehicles and electric cars. BMW is similarly doubling down on its investments in China, especially focusing on EVs with its partnership with Great Wall Motors. The impact on U.S. manufacturing. The growing shift toward China has serious implications for U.S. manufacturing. Historically, German car makers have been important players in the U.S. economy, both in terms of the number of cars produced and the number of jobs supported by those manufacturing plants. But with the rise in tariffs and the cost of doing business in the U.S. becoming increasingly uncertain, the focus of investment is now shifting. According to the German Chamber of Commerce, between April 2024 and April 2025, German companies in the U.S. have faced a 15% reduction in investments. In the same period, German companies in China saw a 20% increase in direct investments. This trend is particularly concerning for U.S. automotive workers. Every new factory built by German automakers in the U.S. would create thousands of jobs in both the factories and in the supply chains that feed them. But with factories now being built in China, these potential jobs are being created overseas instead. China's dominance in key components China is also emerging as a crucial hub for the manufacturing of key automotive components, particularly in the EV and battery sectors. Global supply chains are increasingly integrated into China, with many automakers depending on Chinese suppliers for batteries, semiconductors, and other essential components. A recent study from McKinsey & Company predicts that China will dominate global battery production by 2027, controlling over 70% of the world's supply. This makes it all the more vital for companies like Volkswagen, BMW, and Mercedes to establish a stronger presence in China to secure access to these critical components. The role of local government and incentives. What further attracts German automakers to China are the government incentives for both local production and electric vehicles. In particular, China's government is committed to becoming a global leader in EV production. This includes heavy subsidies for EV buyers, tax breaks for manufacturers, and major investments in EV infrastructure. According to data from the Chinese government, more than 20% of all cars sold in China in 2024 were electric, a figure that is expected to rise significantly by 2030. This presents a massive growth opportunity for German car makers that are looking to establish themselves as leaders in the EV space. Meanwhile, U.S. policies under President Biden's administration are pushing for EV production as well. But the tariffs on foreign vehicles and uncertain trade relations with countries like China are creating challenges that make China an increasingly attractive destination.
As of April 2025, a dramatic shift has occurred. On April 12th, a massive cargo ship loaded with U.S. soybeans navigating across the Pacific Ocean received an abrupt rerouting order from China's government. By the time the ship reached Singapore, it had already been diverted to Brazil, marking the start of a significant trade shift. In a matter of hours, over 2.4 million tons of U.S. soybeans were redirected, resulting in a devastating $1.1 billion in contract losses for U.S. farmers. This move wasn't just a trade dispute. This was a demonstration of China's power to pivot, affecting global markets in real time. The direct cancellation of U.S. soybean orders wasn't a random decision, but a strategic action aimed at the heart of U.S. agriculture. So why did China make such a bold move? Was it retaliation, or was there a deeper strategy at play? In 2024, China remained the largest importer of U.S. agricultural products, with soybeans representing a vital trade corridor. However, this trade route is being rapidly altered. The USDA's April 2025 soybean report revealed that U.S. soybean inventories surged by 13%, with stockpiles reaching their highest levels since 2019. Farmers in the Midwest are feeling the crunch more than ever before, facing the dual threats of market volatility and the immediate consequences of China's actions. In response, the American Soybean Association projected that this disruption could reduce U.S. farm incomes by 18% this quarter alone. A 20% tariff imposed by the Trump administration on Chinese electronics, metals, and electric vehicle components escalated the tension. China's strategic shift, the Brazil connection. While U.S. farmers suffer, Brazil has been poised to take full advantage of China's pivot. Between 2020 and 2024, Brazil expanded its soybean acreage by 21%, backed by over $11.2 billion in infrastructure investments, positioning itself as a reliable supplier. Brazil's logistics, including upgraded grain terminals and new freight corridors, have made its soybeans far more competitive in the global market. China, with its deepening ties to Brazil, is now securing its supply chain, ensuring minimal disruption to its agricultural imports. As of April 2025, Brazil can now supply up to 70% of China's annual soybean demand, a significant increase compared to previous years. In fact, Chinese investment in Brazil's agricultural infrastructure has paid off in full. Strategic procurement adjustments by China mean that Brazilian soybeans are now becoming a permanent substitute for U.S. exports. Additionally, these soybeans come with fewer restrictions on genetically modified organisms, GMOs. Despite the surge in Brazilian exports, China didn't hesitate to overpay for Brazilian soybeans, reportedly paying $14 to $22 more per ton than typical market rates. Why would China take such a short-term loss? The answer lies in control. According to Minyu, a trade analyst with China's Ministry of Commerce, these strategic moves allow China to secure long-term control over its agricultural imports, which are vital to its food security. U.S. farmers facing a dilemma. For U.S. farmers, the situation is critical. The USDA's April 2025 soybean report showed significant disruptions in soybean exports, and a 13% increase in unsold stockpiles marked the highest April inventory levels since 2019. As a result, U.S. farmers are facing financial devastation. Matt Dunn from Iowa has been vocal about the situation, stating that many farmers in the U.S. are facing bankruptcy as a result of the trade war. "Without our soybean contracts, there's no way we can survive," Dunn added. Economists are sounding alarms over the potential collapse of the U.S. agricultural sector. The Biden administration has yet to offer a comprehensive solution, leaving many questioning whether the U.S. will ever regain its footing as a major player in the global food market. The situation is particularly dire for those in rural America, where agriculture remains the backbone of the economy. The political implications are also becoming increasingly clear. As Chad Bound, a senior fellow at the Peterson Institute, stated in a CNBC interview, China's exit from U.S. agriculture could be a significant blow to Trump's base in rural farm states. Brazil's growing dominance in global agriculture. The rise of Brazil as an agricultural powerhouse hasn't been by chance. It's the result of a deliberate effort to increase its influence in global food markets. In recent years, China has heavily invested in Latin American infrastructure, including strategic ports and railways. According to Reuters' February 2025 report, China has poured over $8.3 billion into Latin American logistics, including port expansions and rail projects, making Brazil's supply chain more efficient than ever. In fact, over 64% of China's soybean imports in 2024 were funneled through logistics networks with direct Chinese involvement, solidifying China's control over global agricultural trade.
$14 billion in cargo is missing, and the Port of Los Angeles is seeing a significant drop in shipments. China hasn't flinched. Instead, the tariffs imposed by President Trump on April 2nd, which raised duties on Chinese goods to 145%, sparked a drastic response from Beijing, cutting off nearly half of the Port of Los Angeles' traffic. This wasn't caused by a disaster or cyber attack, but by a single economic decision that's affecting American retailers, importers, and the global supply chain. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. Gene Soroka, Executive Director of the Port of Los Angeles, reported that the next week's cargo volume is expected to fall by over 35% year over year.
Gene Soroka says Trump's tariffs will cause shipments from China to drop by 35% next week.
Hub of imports will be down by more than 35%.
Marking a drop of approximately $10 billion in merchandise. According to Reuters, major U.S. retailers have already halted shipments from China, and the consequences are starting to show. The tariffs were supposed to force China back to the negotiating table, but instead they've resulted in a silent response from Beijing, pushing U.S. importers into a financial crisis. Bloomberg's shipping data reveals that outbound vessels from Chinese ports to the U.S. West Coast have dropped by 40% since early April. This drop, which includes 320,000 containers, has left many shipments stranded at origin, creating a massive backlog. Jim Gerson, owner of Gerson's Companies, a major supplier for retailers, shared that his business, which depends on China for over half of its inventory, has 250 containers stuck with goods worth tens of millions of dollars. He faces a critical timing issue. If products like Halloween, Thanksgiving, and Christmas items aren't shipped in the next few weeks, they will be worthless. Retailers have just 5 to 7 weeks of inventory left before stock shortages and price hikes begin to affect consumers. Soroka warned that the impact won't be immediately visible on store shelves, but will first show up as missing variety. The shipping issues are already rippling across major retailers like Walmart and Target, who have alerted the administration that higher prices and limited selection are inevitable. According to a Bloomberg survey, U.S. imports are expected to fall by 7% annually in Q2 2025, the sharpest drop since the COVID-19 pandemic. As the back-to-school season approaches, toy suppliers like J. Foreman's company, Basic Fun, which relies on China for 90% of its products, are bracing for cancellations, especially if the tariffs remain. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. The disruption isn't just a supply chain problem, it's a potential logistical shutdown. Lars Jensen, CEO of Vespucci Maritime, noted that reopening trade flows after a sudden halt doesn't restore normalcy. Instead, it creates bottlenecks. As ports struggle to recover from the backlog, many expect a similar surge in prices and delays once trade restarts. April saw a 60% increase in canceled sailings from China to the U.S. Compared to the worst months of the pandemic, the shipping industry is already adjusting, but ports in Southeast Asia, which are seeing an influx of rerouted shipments, don't have the infrastructure to handle China's volume quickly. This disruption is leaving businesses with fewer options and soon higher costs. The trade slowdown is also taking a toll on American workers. With imports from China plummeting, the labor market in trucking, logistics, and retail is facing layoffs. According to economist Torsten Slok, reduced Chinese imports could cause a ripple effect, affecting industries across the economy. The World Trade Organization forecasts an 80% drop in goods traded between the U.S. and China if this situation continues. With retailers facing the prospect of empty shelves during the crucial holiday season, the long-term effects of this tariff freeze are beginning to unfold. The $14 billion cargo shutdown is a stark reminder that trade wars come with consequences that reach far beyond the economy. They impact jobs, supply chains, and consumers. The question remains, who will pay the higher price, Beijing or Main Street America? If the U.S.-China standoff continues through the summer, the real cost might not just be cargo, but potentially a $500 billion credit freeze or a devaluation of the dollar. Ford Motor Company is grappling with a seismic shift in its business operations, driven by President Trump's trade policies. CEO Jim Farley recently opened up about the financial turmoil sweeping through the company, triggered by tariffs that have caused massive disruptions in Ford's global supply chain. Shortly after Trump's election, he imposed heavy tariffs on imports from China, a move designed to promote American manufacturing. However, these tariffs had the opposite effect on Ford, making its products much more expensive for international buyers. For a company like Ford, which has depended on a robust international market for decades, this created a financial nightmare. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. The tariffs, initially aimed at reducing foreign competition, made Ford's vehicles prohibitively expensive in international markets. In regions like Europe, Asia, and South America, foreign consumers who once flocked to Ford showrooms turned to more affordable, local alternatives. This drastic change has caused Ford's sales to plummet abroad, straining the company's financial stability. With no demand for cars meant for export, Ford saw its inventory pile up in warehouses, further straining its already tight logistics and warehousing budgets. Meanwhile, key materials like aluminum and steel became costlier to import. The intended goal of boosting domestic manufacturing backfired, as the U.S. supply chain couldn't meet the increased demand fast enough. Ford's leadership was forced to make difficult decisions: layoffs, plant closures, and cuts to research and development budgets. These potential moves stood in stark contrast to Ford's initial plans of expanding into electric vehicles and autonomous technologies. The struggles weren't just confined to Ford. Suppliers relying on the company for contracts were hit hard, and even local economies that had flourished thanks to Ford's presence were bracing for a downturn. The company's stock price took a major hit as investors grew wary of the ongoing uncertainty, and credit rating agencies started to threaten a downgrade, further complicating Ford's efforts to stay afloat. Despite the dire situation, Jim Farley's honesty about the crisis provided a level of transparency that was rare in such a challenging moment. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. He pointed out that the tariffs, while meant to bolster American industry, were suffocating companies like Ford in a world that was deeply interconnected. Ford's global strategy, built on partnerships and international markets, was crumbling under the weight of aggressive protectionism. To adapt, Ford explored a few strategies: shifting production overseas to avoid tariffs, redesigning models specifically for international markets, and doubling down on its electric vehicle investments. However, with finances tightening, none of these solutions were easy or without significant cost. As the company fought to stay afloat, the broader implications for the U.S. automotive industry became clear. Ford's crisis echoed a larger national issue. How can companies survive in a global economy if trade barriers continue to rise? The unintended consequences of protectionism were playing out in real time, with Ford acting as a canary in the coal mine. Ford's financial strain also led to a shift in public perception. For decades, the Ford brand had been synonymous with American strength, but now it found itself being seen as a cautionary tale. Foreign competitors, particularly those not burdened by tariffs, took advantage of Ford's weakened position, further eroding the company's market share. As the situation worsened, internal morale within Ford also suffered. Workers faced job cuts, suppliers were renegotiating contracts, and the company's loyal customers began questioning whether Ford could maintain its legacy. Global marketing efforts faltered as the company's troubles made their way into the media, shifting the narrative from American resilience to corporate failure. Through it all, Jim Farley's leadership was tested like never before. His ability to guide Ford through this crisis, by making painful decisions and keeping stakeholders informed, would define his legacy at the company. In the end, Ford's struggles were more than just a business challenge. They were a reflection of the larger economic shifts occurring worldwide. The once proud American icon now found itself caught in a global web of trade wars, tariffs, and political instability, its future uncertain as it navigated these turbulent waters. Drop your thoughts in the comments, and don't forget like and subscribe for the latest updates on global politics.